the second method we're going to look at for evaluating capital budget projects is the accounting rate of return, or ARR. So this capital budgeting method looks at profitability of an investment, and we can see the calculation below. So it's annual after-tax net income divided by the annual average investment. And the calculation for average annual investment is the initial investment plus salvage value divided by 2. Now, the accounting rate of return is one that has conflicting calculations. This is one of those rates that if you Google it, you will find multiple different ways that it is calculated. That is actually one of the reasons that this is not a preferred method for evaluating capital investment projects. It should be used in conjunction with other of the methods, such as the payback period, and net present value method, and internal rate of return method. It shouldn't be used on its own. One of the things with things that have different ways to calculate them, it's more important that you're being consistent. So if you choose one way, that you continue to use that way. As this is the method that the textbook uses, this is the method that we are going to continue with. Just like to give that bit of caution in case you're looking stuff up on Investopedia or Googling it, that you are going to find other ways to calculate this particular rate of return. So let's look at this example we've got a $16,000 investment. So the same machine that we were looking at for the payback method, only now instead of cash flows, we're going to look at net income. So we're going to use this to calculate the accounting rate of return. So we have 16,000, which is the annual after-tax net income, and the 16,000 is the investment. Sorry. So if we look at calculating this, if I can bring up my tools to write on it, we are going to have our annual after-tax net income, so 2,100. And again, I hate, I'm doing this with my mouse, so forgive me this. Then the annual average investment. So remember, the annual average investment is the initial cost plus the salvage value divided by 2. This machine has no salvage value, so the initial cost of $16,000 divided by 2 is 8,000. So the accounting rate of return on this investment is $2,100 in net income divided by the 8,000 annual average investment, and that equals 26.25%. Okay. Okay. There are major weaknesses, as I described, of the ARR. One of the major weaknesses is that the calculation is not always the same. Another major weakness is that it ignores the time value of money. So just like payback period, it doesn't recognize time value of money, which we'll be talking about with the net present value and the internal rate of return methods. Also, it focuses on net income and not cash flows. And we know from looking at cash flows that net income is not a good measurement of how cash runs through an organization. And if income varies each year, the project might appear desirable in some years and not in others. So as your net income changes from year to year, the project accounting rate of return is going to change from year to year also. let's look at another example. So project A requires new machinery that will require an investment of $280,000 and a salvage value of $30,000. Managers estimate that this investment will have a 5-year useful life and generate net cash inflows of $20,000 for the next 5 years. So we need to look at the payback period and the average rate of return for the investment. So first, we need to calculate what depreciation is. So the depreciation, we'll just use basic straight line depreciation. So remember, straight line depreciation is the investment minus salvage value divided by useful life. So we're going to take our $280,000 investment minus the $30,000 divided by 5. And that gives us a depreciation expense every year of $70,000. Okay, so then we're going to add that, sorry, it's $50,000. The cash flows are $50,000. So that equals $50,000. Then we're going to add that to our $20,000 cash inflows to get net cash flows for this project of $70,000. So to get the payback period, we take the initial investment, so $280,000, divided by the cash flows of $70,000. And that calculation tells us that we will pay this back in 4 years. Okay. The second calculation we're going to do for this is the accounting rate of return. So this, we're going to look at the inflows, so the cash divided by the average initial investment. So 20,000 in annual cash flows, 20,000 divided by, so remember our average annual investment is the investment cost plus salvage value. So 280,000 plus 30,000 divided by 2. Okay, so we calculate that out and we get an annual accounting rate of return of 12.9%. So this project has a payback of 4 years and an accounting rate of return of 12.9%. Now, whether that's good or bad depends on the company. If your company says that you automatically reject any projects with a longer than 3-year payback, you would reject this project. But if they said we accept projects as long as they have less than a 5-year payback, then this one would be acceptable. So it really depends on what your company is asking of you. Okay. Now we're going to talk about the time value of money, but we're not going to get into any of the calculations of time value of money. We're going to save those for in class on Friday. So what a time value money looks at is that $1 today is worth more than $1 to be received in the future. And that is because if I took that dollar to the bank and invested it, or even purchased stock or something with it, a bond, that I would earn something over time. So if I have $10 today, and then I can gain interest on it, that money is going to be worth more in 5 years than a $10 bill given to me in 5 years. So we have to think about cash flows as at their time value of money amount, because we have to think about, if I'm not going to receive money for 5 years on a capital project, so what does that money's value look at today if I'm not going to receive it for 5 years? It's also sometimes called discounting or factoring, looking at the different values of money. So the two capital investment analysis that incorporate the time value of money are net present value, NPV, or internal rate of return, IRR. The information that we need for the time value of money is the principal amount. So what's the amount of the investment? So our principal amount is stated as either a single lump sum or an annuity. What annuity means is that we would pay something every year. So we can either say we're going to buy a building, and that building is going to cost us $500,000. Or we can say we're going to buy a building and its total amount is $500,000, but we're going to pay that off over a 15 or 20-year period by paying the same amount every year on that. So that second example would be an annuity. So what are the number of periods? So it's the length of time that we have. So is the equipment has a useful life of 5 years, then the number of periods is 5 years. If we're looking at a building, it might be up to 30 years. If we're looking at a software system, however long that asset is considered good for, or the payments are going to be, the payment or cash flows are going to be existing. And then the interest rate. What is the interest rate that we are going to use for the business? The term of that interest rate in capital budgeting is also called the hurdle rate. So this is because you have to hurdle it, this is the rate that capital investment projects have to be over in their earnings in order for the company to accept it. So we have future value and present value factors. There are 4 different kinds of values. First, we have the present value of $1. That is the value today of one future amount or a lump sum. So a good example of this is when you see that the lottery is up to $300 million, but then it says underneath in smaller letters that if you took that amount home, it would only be worth $150 million. So that's because the 300 million value is factoring in that you would invest that money and that's what the value would be in 20 to 30 years, because lottery payments can be taken either as one lump sum or as 20-year annuity payments. If we're looking at the present value of an ordinary annuity, that is the value today of a series of equal future amounts. So this is a good one to use if you're looking at how much money should I have in my savings account at retirement if I want to retire and earn $50,000 a year. Okay. Future value of $1. So this is the value in the future of a dollar amount. So if I put $100 into the bank right now, given what interest I'm earning, what is the value of that amount going to be in 10 years if I just let it sit there and earn interest? And then the future value of an ordinary annuity, so the value in the future of equal payments. If I put away $600 a month towards retirement and my retirement account earns this much interest or this much rate of return, how much is the value of my retirement account going to be in 20 or 30 years when I decide to retire? Okay. The net present value method is a method that looks at time value of money. So it's the present value of an investment's net cash inflows and the investment's initial costs. So we use a discount rate, also called a hurdle rate. That rate is the interest rate. So it's just discount rate and hurdle rate are different terms for the interest rate. It is the management's minimum desired rate of return on a capital investment. That rate of return is the same thing as return on investment. If I say that a return on investment needs to be 15% or higher, then my hurdle rate or my discount rate is 15%. That's the value that I would use for those calculations. So we're going to end here because the next slide gets into calculations, and I want to save that for when we're in the classroom together. So we will finish net present value and talk about our internal rate of return, or IRR, in class together on Friday.